Okay, so everyone, welcome to today's lesson. Uh, Alright, so we turn down the volume a bit and we proceed to today's session. So, today's class is going to be a summary of everything about higher time frame trading. Now, the reason why I decided to start to teach you guys higher time frame trading, basically due to the fact that to have a solid foundation in trading, you need to be your higher time frame analysis needs to be very solid because what most retail traders fail to do is they fail to look at higher time frame charts, and they often get so caught up on the 15-minute, the 1 hour, the 30-minute time frames that they get surprised, especially when they see explosive moves in the marketplace. And if you've not done your research, uh, if you go to your charts and basically just mark up higher time frame levels, I'm talking about higher time frame institutional reference points like order blocks, mitigation blocks, and all of that, you're going to see that it is around those levels where you get those explosive moves. And this is due to the fact that the big banks and the central banks also are participating in moves in the marketplace based off higher time frame levels. Okay, so what higher time frame levels helps you to do is not only gives you a long-term direction in the marketplace, it also helps you know what level you can expect explosive moves and prevents you from being stuck in a ranging market where price barely moves. That's going to help you figure that out by looking basically at the higher time frame and solidifying your higher time frame analysis. So what this session is actually going to do is we're going to sum up everything we've taught or we've covered in the last 1 month on the higher time frame series, and basically via my higher time frame series checklist. So this is what I do as a checklist, right? So if you want to do a higher time frame analysis, this is what you need to have as a checklist. You need to cross check them off your list like one by one, and this is basically going to give you the right perspective, what you need to be focusing on, what you need to be looking at in the marketplace, and it's going to prevent you from looking at the things not really necessary when you want to look at the market from a macro perspective or from a macro standpoint. So if you want to look up your charts, if you want to mark up pairs, the first thing you need to do is to go over your fundamentals and your technicals via higher time frame analysis, because this is where the central banks and this is also where the big banks are looking at, and this is where you're basing the majority of your trading at around these higher time frame levels. Okay, due to the sheer volume of contracts or bulk of liquidity that these people or these entities provide in the marketplace. All right, so what we have here on the screen is higher time frame series checklist, and we have for bullish market conditions. We also have for bearish market conditions. So you can take a screenshot, a picture. Take a picture. If you can take a screenshot, also take a screenshot. Okay, if you can take notes, take notes. So basically, this is my higher time frame series checklist. So for bullish market conditions, okay, you wanna first anticipate potential bullish signals. Okay, so you want to look at seasonal tendency. Is this a period seasonally or historically where this pair is most likely to move bullish? That is the question you gotta ask yourself. Is this the period seasonally or historically where the cold pair, where the base pair is most likely to move bullish, and when the cold pair is most likely to be bearish? So some of you guys might ask, what do you mean by that? What do you mean by that, Jim? So what I'm basically saying is, let's say for example you've got GBP USD, right, and you're looking for bullish market conditions. So the first thing you want to check based off bullish seasonals is this the month or is this the time where GBP is the most bullish, or is it the time where it makes a low in the yearly range? And then you now do the opposite for the code pair, which is USD. You have to solve this question: is this time where USD is most likely to be bearish, because what you're trying to do basically in the forex market is to position yourself to trade the strongest pair versus the weakest pair. Pairs basically where you can get very explosive moves and very profitable moves in the marketplace. You don't want to trade two pairs whereby they're both consolidated. You're not making any moves in the marketplace, and that puts you in a very small, tight range. What you're looking for is the expansionary phase in the marketplace, and this is why you always want to pair up the strongest pair against the weakest pair. So the first thing you gotta ask yourself when looking at seasonals is, if you're looking at a bullish market condition, you gotta ask yourself, is my base pair seasonally most bullish around this period, and is the cold pair seasonally most bearish around this period? Because once you have a scenario or a situation like that, you're going to see very, really explosive moves in the marketplace. All right, so the next thing to cross off your checklist is to look for in the market analysis, confirmation, and this is basically fundamental analysis. Okay, so you before you go straight into the technicals, you gotta identify fundamental analysis, which is by looking at the equities. Looking at equities basically is the stock market. Looking at interest rates, looking at commodities, looking at currency correlation. So what pairs or what other asset classes are correlated with the pair you're trying to trade? This is a question you gotta ask yourself, and this is what you need to consider to give yourself a general or a broad overview of market direction or institutional order flow in the marketplace. And the third, basically, the second and the third are basically interrelated in the sense that you're both covering fundamental analysis. So the third basically is to refer to interest rates yields to confirm bullish buyer. So buyer, sorry. So what that simply means is you check the triad, you check the bond market, and by the way, if you're having questions about the relationship between the bond market, interest rates, yields, and currencies, go back and watch the last higher time frame series video I dropped. Make sure you go back and watch that because everything was all covered on that series or on that lesson. Okay, so that saves us from having to revisit that entirely on this lesson. So you refer to the interest rates yields to confirm if bias is bullish. Okay, so what that simply means is if you're looking for basically a bullish DXY, you want to see the bond market go bearish. So you want to check for the bond market because the bond market is going, sorry, you're looking for a bullish DXY, yeah? So you gotta look for bearish bond prices because if bond prices are going lower, that is going to cause DXY to go higher due to higher yield from the bonds. Okay, if bond prices are going down, bond yields are going to go up, and if bond yields are going to go up, that means the currency would go higher. So, which is what you want to look for, and that basically sums up fundamental analysis. And number four, you then go to technical analysis on the higher time frame. So you want to consult your higher time frame monthly, weekly discount array for entries. So remember, if you're bullish, you're looking for a discount array to buy from. You're looking for a monthly, weekly discount array to buy or to base your your entries into week around, because this is the level that the banks are going to look at for bullishness in the marketplace. Then you're going to place the bulk of their orders or the bulk of the volume of your trades from around this discounted level, and then your target would be premium weekly, monthly arrays for exits. So if you're looking for swing trades, if you're looking for short-term trading, even if you're looking for day trading, you could also use all these biases as you'll see in the new series, which is our weekly range series that will be coming up tomorrow. So basically this night, okay, not tomorrow. So what you want to do in a bullish market condition is you want to look for discount arrays to base your entries from, and then premium arrays to find exits around, which is what the banks, the institutions are basically going to be doing. And number five, you want to identify or anticipate bullish quarterly shifts or intermediate pricing. So what you got to ask yourself this question is there a quarterly shift in the marketplace where you can identify where was the last low made? Okay, what was the last long-term low made? What was the last intermediate-term low made? Because remember, in our boot camp, the December boot camp, the first video we covered was the long-term swing low and swing highs, and also short-term swing lows. Sorry, intermediate-term swing lows and swing highs, and short-term swing low and swing highs. So if you're having problems with identifying swing points, make sure you go give that video a watch, because that explains everything about swing points, short-term highs, short-term lows, medium-term highs and lows, and long-term highs and lows in marketplace. So in identifying bullish signals or anticipating quarterly shifts in the marketplace, you have to be able to identify if a basically an intermediate term swing low or a long term swing low has formed. That would be the indication of the market making a shift from a bearish tone to a bullish tone if you're looking for bullish market conditions. So you gotta identify you gotta ask yourself this question: as a long-term swing low being formed, or as a short, intermediate-term swing low being formed, or is it about to form? So you gotta be able to make that decision. Is it about to form, or has it been formed? And we're going to look at examples how to utilize all this. And number 6, you identify the bullish IPDA ranges I expect price to reach for them. So you basically identifying the bullish IPDA ranges, which is the 20-day, 40-day, and the 60-day data ranges, where you can expect institutional fund level liquidity to be resting around those levels. And you're going to look for the market to trade into that level, because this is what the central bank will consider as a very profitable move for them to move the market to that level. Remember, IPDA seeks inefficiency and also seeks liquidity. So using the IPDA ranges basically trains your eyes to see where the liquidity in the marketplace rests, especially the fund level liquidity, okay, which rests around daily levels. And lastly, you want to use your daily PDI rates to confirm your bullish setup before your entry. So for bearish market conditions, you want to do the same thing. You want to anticipate potential bearish signals. Okay, so you look for signal tendency to be bearish. On the base pair, you want to look for signals where the base pair is most likely to be bearish. Then the cold pair is most likely to be bullish. So when you're pairing up a very weak pair with a very strong pair, that is going to cause a massive displacement to the downside on that currency pair. You also want to look for a market analysis confirmation via the stock market, which is equities, interest rates, commodities, currency correlation. So basically, you're looking for every asset class correlated with that pair you're trying to trade, and basically making a conclusion or drawing up a conclusion to confirm if your bias on that currency pair is actually correct or if it is actually wrong. So number 3, you want to refer to the interest rates used to confirm your bearish bias. You want to see if you're, for example, looking at the DXY for bearishness, then you want to see the treasuries rally. You want to see the treasuries making higher moves. You want to see open interest dropping rapidly by 15 or 20%, indicating that the central banks are floating massive shorts to accumulate long positions on the bond prices, which is treasuries. That is going to indicate bearish prices on yields and bearish prices on currencies. Okay. So number 4, you want to consult your higher time frame monthly, weekly premium arrays for entries. Let me shift this to the side. Okay, so you want to confirm your higher time frame monthly and weekly premium arrays for entries. And then you're looking for your discount arrays for exits, because remember, you're looking for a bearish market move. So if you want to base off that bearish market move on the higher time frame, you're looking for a premium level to base your entries around. Then you're looking for a discount level to base your exits around. Number 5, you want to identify and anticipate various quarterly shifts and intermediate swings. So you're looking for swing highs for sell moves. Remember, if you're looking at the bullish market condition, what you're looking for primarily is the swing low. You're looking for either a long-term swing low to be formed or be forming. We're looking for an intermediate-term swing low to be formed or be forming. Now, in a bearish market condition, if you're expecting the market to go bearish, you're looking for basically a long-term swing high to be forming, or you're looking for a long-term swing high to be formed. Okay, or you might look for an intermediate term swing guide to be forming, or you're looking for an intermediate term swing guide to be formed. And number 6, you're looking for bearish IPDA ranges and expect price to reach for them. So you're looking for bearish liquidity in the marketplace where you expect fund level liquidity to be resting in the marketplace for bearish market tone, and you're going to look for price to trade into that level because this is where the fund level liquidity will rest, and this is what the central banks would consider a profitable move in the marketplace. And lastly, you want to use your daily level or your daily PD and read to confirm your bearish setup for execution or for entry. So with that being said, let's quickly look at a uh, uh, let's not make a live example. If you wanted to take a trade, and what I actually discovered just by going back on the charts was USDC chart, a very clean example. Okay, and I'm going to show you just by using our higher time frame series checklist how we can catch moves in the marketplace and can really pair very weak currencies with very strong currencies. So on the higher time frame series checklist, the first thing we want to look at is we want to anticipate the seasonals. So let's go. The currency pair we're looking at for our move is USD CHF. So we want to identify seasonal tendency. Is it seasonally the time for the market for USD to be most bearish and CHF to be most bullish? Or is it the time seasonally for USD to be most bullish and CHF to be most bearish? Or is it a time seasonally where these two pairs don't even do anything really much in the marketplace? So that is the question you gotta ask yourself. That's what you gotta consider. And this is why you want to look at historical price analysis. And if you look at my Google Chrome, you're gonna see the first pair we have is a base pair. I don't know why this gets showing. Okay. Sorry. So the first pair we have is our base pair, which is the US dollar. So if you look at the timeline of this currency pair, this is USD CHF. Okay, so the timeline is, let's go to daily. Okay, so the timeline is May. So it is the month of May. So we're gonna ask ourselves this question: around May, is there any swing high being formed on the DXY, or is DXY bearish around that time period? Because what we're looking for is identification of either bearishness or bullishness. Okay, so is there any bearish signals? Is there any swing high being formed, major swing high, okay, being formed on DXY, or is there any major swing low historically that usually forms around this time period on the DXY? That is what we're going to find out first to know seasonally what the DXY or the US dollar does around this time period. So looking at the seasonal tendency of US dollar, we can see around the month of May. This is the month of May. Major swing usually forms around the month of May going into June. Okay, this is the black line is a 33-year historical price data of the DXY. The red dotted line is a 15-year historical price data of the DXY, and then the blue dotted line is a 5-year historical price data of the DXY. And if we look closely and we study this, where we can see in the last 5 years and also the last 15 years, major highs were being formed on the DXY around May, which is indicated by this level, and then there's usually a very massive drop from May going into June. So around this time period, we can expect that DXY is going to be very bearish based off what we're seeing of historical price data. So historical price data is telling us that in the last 5 years and in the last 15 years, during the month of May going into June, DXY is usually very bearish around this time period, and we can see a short-term and intermediate-term swing high being from around this time period. So that tells us that around this time period we can expect our base pair to be very bearish based on what seasonal tendency is telling us. So now what we need to compare now is the cold pair. Is the cold pair going to be very bullish, or is it going to also be very bearish? Because remember, if the DXY is very bearish and CHF is also very bearish, that doesn't really give us much room to trade because we're now trading two very weak pairs. What we're trying to do is we're trying to pair up a very weak pair with a very strong pair seasonally to see where we can get the most massive displacement in price. So if we look at CHF around the month of May going into June, we can see that simply looking at the 40-year historical price data, which is indicated by the black line, the 15-year historical price data indicated by the red line, and also the 5-year price data indicated by the blue line, you can see that around the month of May going into June, DXY, or sorry, the CHF, which is the Swiss franc, is usually very, very bullish. You can see what happened in the last 5 years, where the Swiss franc makes a low around May. Oftentimes, it even makes the low of the year around May. So the low of the year around on the Swiss franc is usually being formed around May. So this is a time where you can expect very, very strong prices on CHF. So that tells us that currently around the month of May, we're looking at a very weak DXY versus a very strong CHF. So that is going to give us a massive, massive downside displacement in USD CHF. So first off, what we did was we cross-checked off our list seasonal tendencies. Okay, the next thing we want to look for is, since 2 and 3 are interrelated, we want to look for interest rates to confirm our bias, because now we're bearish just simply based off seasonals. We're now looking at a bearish market condition, so we're going to ignore this. We're going to focus on this for bearish market conditions. So what we want to look for is intermarket analysis, okay, via bond prices and yields. So if we go to 10-year treasury notes of June 2019, you can see right here, 10-year T notes June 2019. So the 10-year treasury note is simply what we use as a reference for bond prices in the US. So want to see how that affects the DXY. It was actually time for DXY to drop off. So now remember the relationship between the 10-year treasury notes and the yields slash currencies is, if 10-year treasury note is in an uptrend or is rallying, you want to see the DXY make very massive drops in prices, because your correlation is inverse. If one is going up, the other goes down. If the other is going down, one is going up. So we can see around the same time period of May, when we're looking at chart, okay, you can see that the 10-year treasury note made a swing low back to a bullish order block, and then there was a very major swing that was formed around that level that price hadn't reached into. Okay, now if you look at open interest, remember, if open interest drops down quickly by 15% or 20% or more, okay, remember, if open interest drops down quickly 15 to 20% or more, that indicates that the central banks are massively offloading short positions to quickly build up long positions, and that is confirmed by this explosive move off this range. Okay, so once price breaks out of this swing guide, we know now that treasury notes, 10-year treasury note is now very, very, very bullish. And if 10-year treasury notes is very bullish, that means that bond prices are bullish and yields is going to be bearish. Remember, if yields is bearish, currency prices chases yield. So if yields are bearish, currency prices will be bearish. So that on the fundamental basis confirms that we want to be massively bearish on DXY. Okay, so what we then look for is number 4. We want to consult a higher time frame monthly and weekly premium arrays for entries and discount arrays for exits. So what we look at now is the DXY. We want to look at the DXY, since the DXY basically is the major influence on USD CHF. So we want to look at the monthly and then the weekly arrays to identify levels where the DXY can drop from. All right, so let's do this. This is a monthly time frame. Okay. All right, so if you look at the market from a monthly level, currently there's nothing to reference on the monthly level in the DXY. The market is still very bullish. Okay, but remember, if fundamentally the market is going bullish via high interest rates, during that bullish market, there can be months or seasons where the market is going to go bearish. A quarterly shift, we call this quarterly shifts. So quarterly shifts are basically 3 to 4 month periods in price, where basically IPD has to drive price to levels of liquidity before continuing the long-term move on a fundamental basis. Okay, so make sure you're thinking of all these things. So if you look at the monthly, currently there's nothing to represent the monthly. So the average or the basic retail trader will look at this and say there's nothing going on. Price is clearly bullish. Let's keep doing the same thing. No one is really going to expect that the DXY can go bearish. Okay, so now if you look at DXY on the weekly basis, you can see that equal eyes were just taken out. I'm going to use green colored lines for this. So equal eyes were just taken out on the weekly basis. So price started to that eye. If price falls below the green line, that tells us that we could be in a potential quarterly shift bearish before the continuation for the long-term move up. So now I just want you to think like a central bank. Okay, think like an institutional trader. So if the market has been going up higher, right? And look how slow the market has been driving up. What do you think is going to rest below all those lows? What do you think is going to rest below all those swing lows? Obviously, it's going to be liquidity stops, liquidity in the form of stops, either be it retail stops or be it fund level stops, because the market is bullish and people, the general position is going to be buy moves. So people are going to be in long-term buy positions, expecting the market to move higher. And if the general public or if the retail traders plus the hedge funds are in a general bullish position, what do you think the central banks are going to do? The central banks are going to hedge against those fund level positions plus retail traders, because this is what the central banks do. They hedge against the opposite players in the marketplace. So if we look at this level and prices, you just look at a swing eye, and we know seasonally this is a time where the DXY can be very bearish, and we just saw via open interest, massive drop in open interest, plus 10-year treasury notes took out the last swing eye. We know it's going to be an explosive move from here because now we've left this small trading range. Okay, so what does that tell us fundamentally on the DXY? It tells us DXY is going to be bearish, either be short term or long term. We don't know. Okay, until we see a break in market structure, we can then see long term. But for short term, we can assume the DXY is going to be bearish based off the conclusions we've drawn up from a fundamental basis, also from a seasonal standpoint. So, if we look at the market from a daily perspective, looking at technical analysis now. So we've gone from weekly, from monthly to weekly to daily. Now remember, there's nothing on the monthly to base our analysis off of. Then on the weekly, we only had swing equalize to base our analysis off. So on the daily, we got to ask ourselves this question. If we go back to the checklist, remember you consult your higher time frame monthly, weekly premium areas for entries and discount areas for exits. Then number 5, you identify or anticipate bearish quality shift and intermediate price swings. So if we go back to DXY, remember if you can't spot one bearish quarterly shift, you gotta anticipate that. So what we're doing currently is we're not yet already spotting a bearish quarterly shift, because this right here could be a long-term swing guy in the process of being formed, or an immediate-term swing guy in the process of being formed. We're not sure yet until price gives us a break in market structure to confirm if this was actually a short-term swing guy, a long-term swing guy, or an intermediate-term swing guy. So we don't know that yet, but we're anticipating based on what the 10-year treasury note has told us, and also based off what seasonal tendencies has told us. So now, what we're then going to do is we anticipate bearish correlation being formed in the marketplace. Then the number 6 now is you identify bearish IPDA ranges and expect price to reach for them. So if we know that the general market move has been to the upside, and we know that lots of people are going to chase this up move, and lots of people are going to see this level as a breakout. Okay, lots of fund level liquidity will consider this a breakout system, because you have old eyes around this level, and price looks like it's basically gone outside of this range. So remember the qualification for a breakout system. If you want to see price breakout, you want to see the candle move clearly away from that level. But look how when this candle moved away from this level, it quickly pulled back below the range. the market, the price tried to move away from this level once more, quickly pull back below the range. That tells us that this really isn't a breakout system. This is more like a turtle soup setup in play. Okay, so that is, we're bringing different confirmations to see that we're short term or on an intermediate term basis, we're bearish on DXY. So now the next question I'm going to ask yourself is, where is IPDA? So this is where we bring up our data or our date ranges, and we look for the last 20 days. Okay, so this is the last 20 days worth of price action, the last 40 days of a price action, the last 60 days worth of price action. So now we've identified IPDA ranges. All we then want to do is we're going to draw out an arrow to indicate 20-day low. Okay, so this is our 20-day low. Okay, this could be a target for price, 20-day low. All right, so the next level is our 40-day low. That will be the next target for price. Should price take out the 20-day low? And lastly, our final target would be our 60-day low, which would be this level. That could be a potential target for price where fund level liquidity would rest. Now remember, we're using IPDA ranges because the fund level liquidity or the fund level traders especially trail stop losses based off daily swing lows in a bullish market conditions. So make sure you have that written down. The fund level traders trail off stop losses or trail off positions based off daily swing levels or daily swing lows in a bullish market condition, especially 20-day and 40-day swing lows. So the swing low formed in the last 40 days or the swing low formed in the last 20 days, these guys or these entities, these traders are going to place their stop losses below those levels, expecting the market not to get or the market not to reach for those levels. And this is where we as institutional traders come in and say, no, we can expect the market to reach for that level. And we're actually even going to bet against you. So now we've been able to drop a conclusion. We know where the DXY is going to reach for. Now we simply translate that to USD CHF. We know the DXY is bearish, so we'll look for monthly level on USD CHF. So on the monthly basis, this is basically the price basically went up to a monthly premium array because remember we're at the top end of this monthly range. So this is a monthly range. Okay, so monthly range all the way down from here to this level is a monthly range. So once you pass the midpoint of the range, you get into premium levels. Okay, so currently now this is a very premium level. Monthly rejection blocks around that level, which price just traded into. And you can look how cleanly 1, 2, 3, these three candles formed before the market went up. So that would constitute a rejection block. And then we can expect price to reach for that level since we're bearish on the DXY and we're very bullish on USD. So we simply take that down to the weekly level. So begin to find precision entries. So the weekly level now, the next level in form of a discount level. Because remember, if we're bearish, we're looking for premium levels to sell from, and we're looking for discount levels to take profit from. So if we're going to take profit on a swing term basis, our first TP would be the midpoint of this bullish candle. Now the reason why we're not using the top end, the open slash the high of this bearish or this bullish order block is due to the fact that price has just reacted off that level. So if price has just reacted off that level and price fails to break past this last candle, that means price is basically seeking that more downside price action. And this will be the first level to look for before this next level, which is our uh, monthly rejection block. So we identified monthly range. This is a monthly bearish order block, sorry, weekly bearish order block. So that is a level where we can expect the market to retrace into. Then we go simply down to our daily time frame. Okay, this is where we begin to break it down to a daily time frame. And then around this level, we can expect basically that the market would sell off around that level. So if we're going to do this, okay, without even looking at the smaller time frame, we could do something more like this. We could base sells off this level. Okay, so you want to add a few pips to consider broker spread. This is actually daily level. So obviously you can modify your entries on smaller time frames to suit you. No, but for now, this is higher time frame series. We're looking only at the daily, weekly, monthly levels. The next video we're going to start to cover 4 hour time frame and smaller time frame. But for now, we're looking at these levels for swing trades. And obviously, you're going to put your stop loss above the last premium institutional reference point. So we don't expect the market to get back to this level because there was a very, very massive range around this level. I remember in the last webinar or the last lesson, I said in the ranges, this is where the institutions, accumulate moves to unfold longs or to unfold shorts. So we saw a range before the market switched trend. That tells us inside this range, that was where the institutions accumulated positions. And we don't want to see price go back to the top end of this range because that will put the central banks in massive drawdown, which the central banks will not allow as you're inside of that position. So this is what we can look at for short-term move. Then for swing-term move target, we can look at that level, okay, on USD CHF. And now let's see how this plays out by pairing up a very weak pair with a very strong pair. Okay, so now also one more thing to note is in trading swing trade moves, whenever you see a retracement against the trend, you wanna if the trend is bearish and you're seeing a bullish retracement against the bearish tone, you always want to sell more and you always want to stack up with that move until price gets to your until price gets to your discount target projection. You wanna wanna find every opportunity to find more entries in line with that move. So you look at this level. This is the 50% of this daily order block. Daily order block, 50%. So move to this level. So that would be a very good level to short the market from, and we can add an extra entry from around that level. Okay. So if we're going to add an extra entry from around that level, our stop loss obviously has to go up, not necessarily all the way up to this level. Okay. Our stop loss has just to go up above our first entry, okay, a few pips above the first entry. That is where our stop loss would go, and then you can reduce the stop loss, expecting the market to go all the way down to a discount price point. So until the market gets down to this level, you always want to sell any up move in your bearish market condition. So exactly. So now we have all targets. It's first target 8, second target 8, and basically this is how you want to trade the market on a higher time frame basis. So hopefully this webinar was very insightful to you. This brings us to the conclusion of our higher time frame series. I'll see you guys next time when we go into our weekly range trading. So with that being said, trade safe guys. See you next time.